Good morning, ladies and gentlemen. Welcome to the CentralNic Group PLC Q3 investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and will publish responses where it's appropriate to do so. These will be available via Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Ben Crawford, CEO, and Michael Riedel, Group FD of CentralNic Group PLC. Good morning.
Good morning and thank you. And thanks everybody for attending today. So as mentioned, this is our results for the first 9 months of the year. And I think the headline number here is our organic growth number, which was 29% for the first 9 months of the year. And to give you a bit of color to that, we're a company of two halves. We have two separate lines of business, separate but related. The online presence business, so that's where we sell domain names, web addresses, email software, and so on. So all the basic tools to get a company online. And these are all a subscription model, recurring revenue businesses. So essentially all of these services, you have to pay an annual fee to retain, and if you don't pay that fee, you lose them, meaning your website goes down, your email stops working. The organic growth for that part of the business is 9% in the first 9 months. As you can see there, we've calculated it by adding back for the one company we acquired in this segment during the course of this year. We added in the revenues that they earned in the first 9 months of last year before we owned them, just in order to measure a absolute like-for-like comparison of the businesses we own now with how they performed in the first 9 months of last year. And so that's the orange tip of that left-hand bar. The second part of our business is online marketing. So this is for people that already have their website and need some tools to help them earn money. Essentially, we have tools for both of the business models. For the internet, on the one hand, for people that have high amounts of traffic. So this may be because they have a blog or a news feed or something like that on which is attracting traffic to their website. And what we do is we place advertising on their website, and we do that on an exclusive basis for around 20 million websites. And because of that massive volume, we have a huge amount of data about the traffic and about what kind of advertisers advertise on what types of traffic. And we have an artificial intelligence engine behind that, which is continuously optimizing to get those customers the highest amount of money they could get by matching them with the best, highest spending advertisers. And as we we're on a revenue share. Obviously, the better job we do for our customers, the better job we do for ourselves. Here again, you can see that we've added back or added in the 9 months of trading from last year, from before we owned two of the companies we've acquired in the last 12 months. And that brings us to a 47% organic growth rate. Obviously, the best growth rate that we've ever had for any business, and there's a number of factors in that. So, firstly, we're new to this industry relatively. We started buying online marketing businesses only 2 years ago. And one of the reasons that they were so attractive was that the growth rate, the underlying growth rate of the online marketing segment is 25%. And so obviously that's appealing, but we're actually doing even better than that. And before we get into more detail, it's worth talking about what the recurring revenue model here is. And here it's a bit different. It's not an annual fee. It's rolling contracts, and it's a kind of utility style continuous billing. And this is because for those 20 million websites where we have exclusive rights to their traffic, they all have ads on them, and people are pretty much continuously clicking on those ads. And so essentially we bill those advertisers, and we collect the money and we remit it to our partners on a monthly basis. But we're actually earning money constantly every day of the week. And similarly, on the other side, where we work with the advertisers, these are companies that are selling things online and trying to acquire customers to their websites. They have a marketing budget in order to do that, which they spend on advertising. And we, using our tools, they can access 100 million different websites, and we can place ads on those websites for them. And so and again, there we take a percentage of their online advertising spend. So there again, they will test, make sure that we're doing a good job, that we're delivering them customers where they can get a decent return on investment. So if it costs them $10 to get a customer, but they make $30 profit from them, obviously what happens then is they set and forget. Essentially, they use our tools to generate a continuous stream of these customers coming to their website and buying from them. And so there again, it's a repeat revenue model where we're continuously earning revenue, spending the marketing budgets for our customers, bringing them customers that spend money on their websites. And so why are we doing better than the market? There's a couple of things. One is we do have a patented technology that we launched only at the beginning of last year, which has been a dramatic help to us, and that's in that media buying suite of products. So essentially, it helps advertisers or online marketers gain access to all kinds of traffic that is difficult to find on the internet. But the second thing, as we'll see in the next slide, is we've actually done an awful lot of work in reorganizing our company in order to drive organic growth. At the beginning of last year, we were relatively small in our head office function. We'd made quite a lot of acquisitions, and each of our portfolio companies was relatively autonomous with the CEO. We restructured about 18 months ago and built a very significant head office function with IT services, with HR, legal, group finance, including a broader range of things, tax, sales tax, treasury, and so on, as well as a product team, a project management team, and so on. So we did a lot of senior hiring, and we introduced a lot of new systems and software, things like Salesforce, Zendesk, Jira, G Suite, and others. And so that was a significant investment. But what it meant was that instead of needing a whole group of CEOs, all we really needed then was a group of commercial people that could drive the organic growth. We grouped our businesses into divisions. We put people in charge of them, and essentially rewarding them for driving organic growth. And that has really paid off for us as a company, as you can see from the results. And put simply, $10 million of annualized investment has already produced $63 million of additional revenues above what we earned in the same period last year. One thing we need to consider carefully is, is our growth related to COVID? I think the simple answer is no. We actually got mixed results during 2020 from COVID. It helped some of our businesses, it hindered others. But the thing that is clear is that as the restrictions related to COVID are relaxing and people are no longer having to come up with new internet businesses from their home, they can go back to their old jobs. Our growth's accelerated. So it's really very clear that our growth is much more an effect of us getting into online marketing and restructuring our business, and really has little to do with COVID. On the other hand, one external factor that does play a role is GDPR and the moves by Apple and Google and others to restrict third-party cookies. So essentially what these things are is restrictions on use of private data, collecting private data, selling private data, and monitoring people's use of the internet. And happily, our online marketing businesses never did any of those things. So we've always had privacy safe solutions. And no doubt the fact that our solutions are privacy safe has helped us and will continue to help us in future as some of our competitors are struggling with these new restrictions and regulations, which leave us completely unscathed. When it comes to operations, really, there's two key points I'd like to draw to your attention. Firstly, we recently announced the hiring of Carsten Syrup as our new Chief Technology and Product Officer. Carsten was, up until he started with us, the CIO of GoDaddy, the largest company in our industry. And he joined that through an acquisition. He was before that the CTO of Host Europe Group, a company very similar to ours that did 22 acquisitions, and he was in charge of integration. They eventually sold for £1.5 billion to GoDaddy a few years ago. So in coming to us, it's like he's coming back to the familiar smaller roll-up strategy type of business, and obviously he's extremely valued joiner, as he's done this before and is probably, as far as integration's concerned in our industry, the leading technological expert. One other point I'd raise about data science and artificial intelligence: when we started to acquire online marketing businesses, they came with data scientists, with software developers who were specializing in artificial intelligence. And those technologies give us a real edge and help us optimize our performance in our online marketing businesses, to the extent that we decided to move that expertise into our back office and head office function, so that all of our businesses could benefit from that, and we could apply it to customer service and marketing and many other activities to essentially make us a more data-driven and automation-driven company than we've been before. You can read the rest of the operational highlights, but I think those are the key ones. And so with that, I'll now hand over to Michael Riedel, our CFO, to take you through the financial highlights for the first 9 months of the year.
Thank you, Ben. And while on the first two slides, we've been very much focusing on how we grew the company, the good news is that all financial metrics, starting with gross revenue down to operating profit and adjusted cash flow, are all up materially. Gross revenue increased by 2/3 to $282 million. Net revenue by 60% to more than $85 million, and adjusted EBITDA by nearly 50% to almost 50% to $32 million. But the two figures that grew the most dramatically are the operating profit, which went from near break even to already a high single-digit million amount just for the first 9 months of the year. And the adjusted cash flow has grown also faster than our gross revenue at 77% to more than $36 million in the first 9 months of this year. Looking at the income statement in a bit more detail, you may have noticed that the gross margin reduced by roughly 2%, given that revenue grew faster than net revenue. However, it is important to note here that this is not representative of a margin erosion, but simply a change of the blended gross margins through the different business mix. As you can tell from our most recent quarterly reports, our online presence segment has a gross margin of roughly 37%, and that is very stable or that has been very stable over the last few quarters. And our online marketing business has a 26% average gross margin, which has also remained quite stable over the last few quarters. And the decrease in the group gross margin is simply the result of the online marketing presence, which has a lower gross margin, growing at 47% as compared to 9% of the other business, but no erosion of the profitability in the two segments. Secondly, and that's probably also very important, is that now finally our adjusted EBITDA starts translating into operating profit and also, of course, other metrics below EBITDA. And while the adjusted EBITDA has increased by $10 million rounded from the first 9 months last year to the first 9 months of this year, the operating profit has increased by $8 million. However, when we look into the bridge and between the two, and in particular the single largest item, amortization of intangible assets, we see that just the increase in amortization of intangible assets more than fully explains the $2 million variance between the increase in adjusted EBITDA and the increase in operating profit. And the amortization of intangible assets is an accounting practice that particularly penalizes acquisitive companies like ours, where we would, after each acquisition, need to allocate a certain part of the purchase price to intangible assets like trademarks, customer bases, assembled workforce, and similar, and then write them off over an assumed useful lifetime. However, our customers will still be around many years thereafter, and our trademarks will still be there, and the workforce is also still there. And other than for tangible assets which undergo a physical wear and must be replaced at some time, here there is never any replacement capital expenditure, neither this period nor in any future period. And this is why this is an entire non-cash accounting artifact. And as a matter of fact, all equity analysts who cover our stock adjust all their profit analysis for this one item. Moving from the balance sheet, from the income statement to the balance sheet, we see that equity at book value now stands at pretty much exactly 1.5 times our net debt. So the balance sheet gearing comes down. Speaking about net debt itself, it has also reduced by more than $6 million over the first 9 months of this year, despite the fact that we've invested roughly $15 million in the 2 acquisitions completed this year, and by honoring earn-out agreements on prior year acquisitions. So there is a very strong organic deleverage in the business, and net debt to EBITDA, if you just use the current market consensus, now stands at roughly 1.8 times. So also this metric is coming down rather quickly, despite us further investing a part of our organic cash flow into new acquisitions. The question is, where does all this cash come from? So here on page 8, you see our cash flow for operations, just as expressed under IFRS, no adjustments here. The cash flow for operations has almost doubled from the $13.5 million in the first 9 months last year to now almost $25 million, which is already more than for the entire financial year 2020. And given that the cash flow statement is also impacted by our M&A activity, just like our income statement, we started roughly 2 years ago to also systematically provide an adjusted cash flow bridge in which we would basically normalize also our cash flow for the impact of M&A, which is not only the cost directly associated to M&A, like legal fees for due diligence, etc., which have nothing to do with the day-to-day operations of our businesses, but it also includes elements like, for example, the settlement of acquired liabilities, which of course we would always deduct from the purchase price, but whose settlements then count into the operating cash flow under IFRS. After these adjustments, we can actually present a very consistent picture, 108% cash conversion in 2019, 115 in 2020, and now 113% for the first 9 months this year. And this is very important to us to demonstrate, given that it demonstrates 2 points. First, that us venturing from online presence into online marketing did not have any negative impact on our cash conversion ratio, nor did the accelerated growth. And the reason why the accelerated growth also doesn't change our cash conversion profile is that both businesses in online presence and online marketing work with negative net working capital balances, which means the growth is self-financing itself. Let me maybe illustrate that with 2 examples. Our main product in online presence are domain names. For domain names, it is an industry standard that domain names are being paid upfront. So the customers first pay us, then they can register the domain name, and then we pay our supplier. So we first get the money in, and then we pay it down the value chain. And in online marketing, it is not materially different, because in online marketing, other than an unpaid dishwasher that Amazon can come and collect again, the delivered advertising cannot be recovered anymore, and therefore it's also in standard here that the advertisers would first pay money to us. We credit to the customer account. They can then run their advertising campaigns, and then after the end of the campaign, we will determine which publisher, so that's the website that actually shows the ads, has delivered how many impressions, and then we would remit the revenue shares in the month thereafter. So while the 2 services are different, the economics of the services are very, very comparable. With this, we come to the last slide of the financial section, which is some additional background on specific selected income statement items. So first of all, operational expenditure. The operational expenditure has increased by a bit more than $20 million from a low $30 million amount to a low $50 million amount. This $22 million increase, though, is for 2/3 acquired operational expenditure through the 3 acquisitions that we completed since the end of the comparative period last year. And 1/3 is the prorated part of the $10 million investment that Ben alluded to on the second slide of this presentation. Amortization of intangible assets, we already addressed at the occasion of discussing the bridge between adjusted EBITDA and operating profit, so in all non-cash item. Third, non-core operating expenses. These have now come down materially as expressed as a percentage of our EBITDA. Again, for memory, we basically have 3 main compartments in here. The first being acquisition cost, which would have been historically been considered as part of the acquisition cost of a target. This is all the cost for identifying the target, doing due diligence, closing the deal, and refinancing the transactions. The second part, integration, is basically all the cost that it takes to restructure the businesses to make part of the CENTRALNIC ecosystem, which would then in subsequent periods lead to operating leverage. And the third item we called other. Other is we used the euphemism of other because it was a proper strategic review, which should not be misunderstood with the city code word for a sales process. So in the strategic review, given that CENTRALNIC was standing on one leg, being online presence until late 2019, it had then grown very quickly a second equally strong leg of online marketing. And together with the board, we agreed to explore the specific merits and opportunities of both these businesses to determine how to allocate our future resources. And in essence, or in a nutshell, the outcome is that both businesses are great businesses, and this is also why the board has agreed for us to nurture both businesses. And you can see that in our deal flow this year, the acquisition of Safe Brands has strengthened the online presence business. The acquisition of Wando has strengthened the online marketing business. And going forward, we would expect to see a similar pattern. The last item to conclude, this is now a bit more forward-looking. In 2019, the UK equity markets have been particularly weak because of Brexit and many other factors. And this is why at that time we chose to finance our acquisitions with a bond. And I should maybe make this side remark here that we would only raise any debt or equity for acquisitions, because we neither have huge investments in intangible assets, nor would we need to pre-finance any working capital balances. So M&A is virtually the exclusive purpose of any fundraising. But in 2019, we then chose to rather go to the debt capital markets than to the equity capital markets, given the circumstance at the time, and us being literally just a quarter of the current size. Looking at the run rate, we ended up with a 7% coupon, which still ranks quite well to other UK issuers at that time, like Aston Martin, who had to pay 12%. And I'm just mentioning them because they were raising equity in exactly the same 2 weeks. Raising debt in exactly the same 2 weeks that we've been in the market. The good news here is that when we issued more bonds in the beginning of this year, we've been offered a premium on what we need to repay to the bond investors, which lets us estimate their expected yield, which seems to be 2 to 3% lower than at the time when we first issued our bond. And this becomes now particularly interesting, given that there is a window for refinancing which opens in July next year, and we will of course need to explore our options at that time. And if we can really crystallize this expectation from or this observation from the last fundraising, this could lead to interest savings between $2.5 million per year and upwards. And we will keep the market informed about our next steps on this matter. With this, I hand back over to Ben, who will run you through M&A, ESG, and strategic priorities.
Great. Thanks very much, Mark. So in addition to this organic growth, we have been and intend to continue to grow inorganically as well. We have an excellent track record, and we have some real competitive advantages. And one of the key ones is that we're a global company that does business with almost every other company in our industry in the world. And that means that they know who we are. We have an existing relationship. We're able to observe them from close quarters and identify the great, attractive, growing companies. And essentially that has allowed us to approach companies and cut deals with them without them going into a formal auction process and saving significantly on advisors' fees and so on, which is all very helpful in that we're clearly a value buyer. What we love to do is deals that are immediately earnings accretive. And certainly we've never done any that aren't where earnings accretion isn't within easy reach for us. Now, the other characteristics we're really looking for are recurring revenues, high cash conversion, and low churn. In other words, exactly the same investable characteristics we already enjoy as a company. We wouldn't want to dilute those attractive characteristics. Whilst we are looking at companies that bring us new products, for instance, we're not looking too far afield because we do like to have achievable synergies. Those synergies tend to fall into two buckets: the kind of low-hanging fruit that we can do operationally, and then the technical integrations of platforms, which in our industry are complicated multi-year projects. But as I mentioned, now we have our new CTO. We really have the top man in our industry in terms of achieving those technical synergies. And lastly, we do because we do business in almost every country in the world, we have some visibility of the growth markets and the products that are working all over the world. And so we try to use our acquisitions to expand our market share in growth markets, as well as to bring in new products that we can cross-sell to our existing customers. Once we do acquire a company, our first integration priority is typically to switch their suppliers and back office functions to our core suppliers and core functions. That gives us more control over the businesses, and it enables us to benefit from the additional buying power that we have from those businesses. Our second focus is actually growth. So it's not unusual for us to invest in businesses soon after we buy them in order to drive that growth. Because as I mentioned, whilst we will achieve every synergy that's achievable, it can take years in our industry. And then lastly, even if we achieve a synergy, we shut a platform down, migrate all of the customers over to another platform. That doesn't necessarily mean that we let all the staff go, because it's a very competitive market for talented staff. And if they have some great software developers, engineers, and so on, we will typically keep them and throw them onto a project to drive our growth further. Now, moving to ESG, we're a little bit unusual in that we were the first domain company to ever announce that we were carbon neutral back in 2012 before we IPO'd. So it has been a focus of ours for a long time. However, we did acquire a lot of companies that were not carbon neutral, and so it's taken a lot of effort and some offsets in order to bring us back to being carbon neutral, where we are again today. We have an extremely diverse workforce, happily, and we consider diversity of that workforce to be a priority as we move forward. We have a grant project or a grant program called the CENTRALNIC Fund, where we have now donated 600,000 euros in grants, supporting initiatives around education, around cybersecurity, around accessibility for the disabled, and most recently in combating fake news. And then lastly, I guess inclusivity is actually really core to what we do as a company. Our mission statement is making the internet everybody's domain. And we're succeeding in doing that, in that we have one customers in almost every single country in the world. And what we do is very different from other tech companies. We're not giving them a passive experience, bringing them Western culture and taking their money out of the country. We're not collecting their private data and selling it to other people. What we're selling them is the tools to build their own businesses online. And we believe that that in itself is instrumental and will continue to be in making the internet more inclusive and representative of the world as a whole. So this is our last slide, and it's what our strategic plans and objectives are moving forward. So you've heard a lot about organic growth. Not surprising that it's there at number one. And we are growing. We're using all the different levers for growth, winning new customers, upselling and cross-selling our services to existing customers, launching new products, contracting with new suppliers. Operating leverage is very important to us, and it is something that we definitely see in our future, with a few drivers for that. One being the integration savings that we've discussed through the technical integration programs that we're undertaking. But secondly, and I'd say more importantly, is simply scale. We're a platform business. And that means that particularly now that we've done our big kind of investment into our staff and systems, we expect that spending to plateau, whilst as we win new customers, sell more products and so on, our revenues to increase. And indeed, if you look at our larger scale peers, the ones listed on NASDAQ, for instance, you will see that as companies grow much bigger, their margins improve a lot in our business, and that's absolutely what we expect to see. M&A, of course, we will continue. We have a strong pipeline of attractively priced deals. We've already done 3 this year, including 2 at 4.5 times trailing EBITDA. We're very good at finding great value deals and integrating them and growing them. So we would certainly be continuing to do that, both on the online presence side and the online marketing side. And then lastly, when it comes to debt, as Michael has mentioned, our bond will be able to refinance our bond as early as July of next year. And based on our most recent experiences in the bond market, we are certain to get that interest rate down below 5%, with obviously results in savings and additional cash conservation for us. And lastly, our net debt to EBITDA ratio, it's below 2 at the moment. We know that's, we from having spoken to all of our institutional investors, we know that's around their comfort level. We certainly aren't planning to increase it below above 2.5 times. And our interest rate coverage is well north of 4 times at the moment, and we would expect to continue it the same way. Obviously, lenders are very keen to talk to us and want to lend us more money. The thing that's really restraining us here is understanding that our equity investors would prefer to keep our debt levels low, and that's what we're doing. So that concludes our presentation for our results for the first 9 months of 2021. I think at this point,
Fantastic.
Before we go to questions, I'll hand back over to our compere.
That's great. Ben, thank you very much indeed. Ben, Michael, thank you very much indeed for the presentation today. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you that recording the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order the team can better understand your views and expectations. Ben, Michael, I haven't given you a huge amount of time to have a look at those questions that have come through, so apologies. But and thank you to the investors for submitting those. But if I may just ask you to click on that Q&A tab, and where appropriate to do so, if you could read out the question and just give your response, that'd be fantastic.
Sure, very good. All right. Well, question 1 is Bob M. What is the biggest threat to your continued growth? I've read all the questions. They're all good. So thank you all, and thank you, Bob. Happily, we're in a recurring revenue lines of business, which means that it's very predictable from the customers we have now what kind of spend they will continue to have in future. It is a sticky industry, so that means it is a difficult task to win customers away from our competitors, but it's very difficult for them to win customers away from us as well, and that's because there's all kind of switching costs and complexities and so on. So I'd say that is always a challenge, to try and win customers away from competitors is always difficult, although we continue to do it, and our growth does depend on us being able to do that. But overall, the people who are up for grabs are the new customers, the new entries, and happily that's just continuing and continuing. So we don't really see that as a threat. I mean, interestingly, what happened when under COVID, it was reported like lots more people got onto the internet and started doing web businesses and so on. But we actually found that was not a particular driver of revenues for us, because many of those people were like beginners and they didn't spend much money, and many of them didn't do very well with their online businesses. And so whilst I think some other companies did cater those people, and so they had a peak and now they're dropping a little bit, we've just kind of grew all the way through it because I guess we didn't take a big bet on those kind of COVID-driven new customers, and that tends to be the same thing. The main drivers of growth for us are so reliable. They're essentially the growth of the internet. As more and more people get on the internet, you know, as e-commerce grows beyond the $4 trillion mark, as online marketing grows beyond the $400 billion mark, and as online presence services grow beyond the $40 billion mark, we kind of ride on that underlying growth. So I'm not sure if that really answers the question, but that's essentially where we sit in the market. I've got a lot of questions here, so I'll move on. Morgan B asks, do you think that Unified ID Solution 2.0 will become the new cookies? How does this impact on CENTRALNIC? It doesn't really impact on us. So, UID 2.0 is essentially a method where advertisers track customers because the customers volunteer their data and are tracked by an email address, exactly the same way that, say, social media works, where you have a unique identifier, which is your email address. That will obviously help us because it means everyone in the world will need email addresses, and that's certainly a product that we sell. But like I said, we have an alternative technology, which is contextual advertising, which doesn't rely on collecting data about the end users. It's more about collecting data about trends on the internet. So saying if somebody passes through websites that contain these words, they're likely to buy product X and so on. So it's about big data and AI. And we believe that that's a equally viable and actually better and more proven solution than using people's email addresses to track them. Next question is Andy M. Where do you see the operational gearing of the business coming through to drive bottom line growth? I think we did address a little bit after your question with integration, and we just see it through scale. And all you have to do is look at our bigger peers to see that the margins are better as you get bigger because we're a platform business. Yeah, we could add 1 million new customers. We certainly wouldn't have to add a proportionate amount of staff by any means. Morgan B asked, what's your revenue growth rate and margin guidance over the medium term? Thanks. I mean, obviously, that's not really something we can talk about as a listed business, but what we could say clearly is we're covered by Berenberg, by Edison, by Zeus, by Stifel. InvestX put something out about us too, and those guys clearly have formed some views about that. I should say, and we've made it clear that we're now trading at the top, at least at the top of the estimates that are out there in the market at the moment, and so that can give you a bit of a sense of where we expect to land on those things. I know, Michael, you look like you might want to add something there, or you?
Right, basically combining the question you just addressed and the question before. So I think I would invite every investor to not only look at EBITDA expressed as a percentage of our gross revenue, but also to look at it as a percentage of our net revenue or gross profit. As we have explained, both our business have a systematically different gross margin, 37% for online presence, 26% for online marketing. So it might be that or it's even more likely than not, that our gross margin will grow, or gross profit will grow not just as quickly as the gross profit. However, we already see the operational gearing in action. if you actually divide the EBITDA we reported for the first half of the year by the net revenue we reported for the first half, it is a lower figure than if you do the same math now for the Q3. So the EBITDA as expressed as a percent of net revenue is already coming up. So we are already in the profit accretive zone.
Very good. Thanks, Michael. So now, Mazin S asks, are there any significant future integration savings that are yet to be reflected in the P&L? Yes, there are. I think once we have more clarity on that, we'll be sharing that with the market. As I mentioned, a lot of these projects are multi-year projects, so it isn't a month-to-month change. But we certainly expect that to be another contributor to our improved profitability in years to come. Next question from Russell G. Do you see you expanding the security division and product service provision? If so, more organic or M&A? We have a number of security products. One of the big areas for security at the moment is attacks on DNS. And that's an area where we do have a number of very useful products for enterprise and SMB customers and indeed governments. We're currently working on kind of pulling them together into a more usable suite of products. So in that would be organic, but clearly the cybersecurity area is an allied area to ours and one which is getting an enormous budget, and so therefore we do have a look at M&A prospects in that area. And I guess if the right company came along which fit in with us, we'd certainly have a look at bringing it into the fold. Because once we have the customer and they're buying their website, they're buying certain security products from us, if it's something else which fits in nicely into that, of course, it would make sense to look at. Next question from Russell G. Do you foresee offering third-party product service, say payment security, that you take a PA fee? Sure, absolutely. I mean, most of the domain names that we sell are third-party products. We don't own .com. Yeah, we're one of the top 10 vendors of .com in the world, and so that is essentially our business model. Payment security is an interesting area. It's the whole world of payments. I mean, obviously very competitive, but I guess the thing is, as you've seen with our online presence business, essentially we get one payment a year for our online presence services because it isn't really tied to the top line of our customers' business. It's just a fixed cost. Whereas with online marketing, we can get payments every single day. And so we're looking at other services like that, which basically move us up the value chain and are able to drive more revenues and payments. And payment security would certainly be an interesting one. Next question, Mazin S. What's your goal for future EBITDA margins? Again, I'd point you to the the analyst notes on us, and again remind you that our guidance to the market at the moment is we're at least at the top end of those numbers. Quentin B. As a consequence of your acquisitions, you will have hired large teams of software developers and other IT experts, correct? Are you cognizant of the case there will come a time when there is not as much need for continuously changing your platform and might need to cut back on the size and scope of those teams and thus reduce overheads? Of course, that's a possibility, and indeed, whilst we haven't done any large scale layoffs of any sort, we do, I'd say, continuously improve our team, sometimes through replacing people, sometimes through training and so on. As we do reduce the number of platforms, obviously we simultaneously with that, we intend and plan to vastly increase our number of customers, and I'd say that is our number one goal. Of course, we won't ever have people sitting around who are not needed in the company. We never have, and we never will. So, obviously, yes, there are potential integration savings there, but our main focus is more on growth than on cost cutting, and obviously it's paying off very well for us and our shareholders. Mazines has another question. Excluding acquisitions, which of the two businesses do you expect to grow faster? Online marketing. Pretty much for the reason that I've said. It's driven by the business activities of our customers more than just the number of our customers, and with their success, we succeed. It's also the online presence market is a $40 billion market, growing at maybe 5% a year. The online marketing segment is a $400 billion a market, growing at north of 20% a year. So we're also reflecting the market, although obviously beating it. New question from Joshua N. Is there any reason the online marketing division won't continue to grow well ahead of the market growth? What do you see as your total addressable market with the current product set in the online marketing division, i.e. assuming no additional M&A? Total addressable market is, so within online marketing, obviously you have Google, which in the $400 billion online marketing segment, you have 160 plus billion sitting with Google. You've got another 80 billion sitting with Facebook, and then we have Yahoo and Amazon as a growing. So obviously our total addressable market is not, we don't look at taking customers away from those companies. What we look at is niches, and happily those companies, we've heard it direct from our friends at Google, if they can't earn $1 billion in a market, they have no interest in it. And whilst maybe that threshold's a little bit lower for someone like Yahoo, it still leaves us with many markets where we can potentially win market share. I would happily say that the leftover markets that we compete in are it's difficult to define exactly, but at least $50 billion and up to $100 billion of total addressable market. It's competitive. I'm not suggesting that we're going to get there quick, but we certainly are gaining on our competitors, and they're great markets to be. David M. asks, what geographic dimension is there in your M&A thought? I guess essentially where we've landed is, whilst our corporate headquarters is London, our engineering hub is Germany and Poland. So essentially that part of Europe is where the vast majority of our engineering and technology teams are. And then we have customers in almost every single country in the world. And so they are serviced by sales offices, all over the world in all different time zones. So when we make an acquisition, what we tend to do is push the technology back into that kind of European hub. But often, if the company's in Canada, New Zealand, Slovakia, and what have you, have the local sales teams there to manage the local customer base. We have being a global company and being a specialist M&A company, we're more interested in getting great value in an acquisition, being able to drive growth in an acquisition, being able to integrate the acquisition. As we do business all over the world, it doesn't matter to us so much what country that's based in, although obviously we have to pay attention to issues around tax and tax rates and so on. But as a global company, usually we can manage all of that. John A asks, can we see a significant acquisition after the expected bond refinancing next year? As you have said that you should see a significant reduction in interest cost. We're always interested in significant acquisitions. You can't always time them exactly with with other things. It's when they're available to be done. We're clearly a roll-up strategy. There are still fantastic opportunities of companies that are like us, recurring revenue, high cash conversion, high growth, low churn businesses that we can actually drive more growth from and integrate, make savings with. So as long as they remain out there, I think we'll be interested in them. But in terms of timing, like I said, we can't really control when that timing occurs.
Ben, thank you. You've covered every single question. So Ben, Michael, thank you as usual. You've been fantastic with the questions. Of course, if there are any further questions that do come through, the team will be able to review those and we'll publish responses where appropriate to do so back on the platform. Ben, perhaps before we just redirect the attendees to give us some feedback, if you could just give us a closing snapshot just to conclude, that would be great.
Absolutely. So CENTRALNIC is a recurring revenue, high cash conversion business with low churn, growing organically at 29% per year, with a fantastic opportunity to consolidate a market of other similar companies and become one of the great tech companies based here in the UK.
Absolutely fantastic. Ben, Michael, thanks again for updating investors today. Could I please ask investors not to close the session, as you'll be automatically redirected for the opportunity to provide your feedback in order that the team can better understand your views and expectations. This will take only a few moments to complete and is greatly valued by the company. On behalf of the management team of CENTRALNIC Group PLC, we'd like to thank you for attending today's presentation. That concludes today's session. Thank you and good morning.
Thanks very much.